All right, so let's get started with selling. When do you sell a stock? Now let me begin by saying that Chart School is not going to teach you how to sell right at the top. Okay, nobody sells at the top. I don't sell at the top. Mike doesn't. Bill O'Neill doesn't. But you don't have to sell right at the top to make a lot of money in the stock market. How many of you guys have read Reminiscences of a Stock Operator, based on the life of Jesse Livermore? Okay, about half of you. That's a tremendous book, and if you're serious about the market, I highly recommend that you get that book and read it and reread it. That's one of those books that I'm continually reading. There's just a lot of wisdom in that book. It's called Reminiscences of a Stock Operator. And there's a wonderful quote in that book attributed to old Baron Rothschild. When asked for his recipe for wealth, he replied, "I never buy at the bottom, and I always sell too soon." And that sentence really kind of encapsulates our whole system here. We don't buy at the bottom. Mike just went over bases. We buy stocks when they're breaking out into new highs. And we don't pretend that we're going to sell at the top. Okay, we're going to sell when we see the technical sell signals. It might be somewhat before the top. It might be after the stock is peaked. But we're not trying to bottom pick, on the bottom and sell right at the top. It just doesn't work like that. Now, most people find that selling is much more difficult than buying because there are a lot more emotions involved. You really don't feel the hope and the fear and the greed and the pride. You don't feel those emotions until you've got money at stake, until you're in the trade. And those emotions can really wreak havoc with our trading. But by paying attention to the sell signals that I'm going to cover, and not just knowing what they are, but actually acting on them, you can neutralize many of the emotional obstacles that cause us to make bad trading decisions and lose money. Now, when you sell a stock is going to depend on a number of different factors. By the way, my outline here is on page 284 and 285, but you can just pay attention up here, it's fine. When you sell is going to depend on your investment objectives, and a large part is going to depend on your personality. It's going to depend, of course, on the price target you've set for the stock. And, of course, what is this stock doing in terms of its price and volume action? Now, those of you that have been to a Level 2 workshop have probably heard it said that you should be selling some of your stocks when they are up 20 or 25% from where you bought them. The question, though, is which ones do you sell for a 20 or 25% gain, and which ones do you hold on to for the bigger move? Without the benefit of hindsight, that's a really tough question to answer. I mean, the truth of the matter is, you really don't know which stock's going to turn out to be the really huge winners until after the fact. CanSlim is going to help, technical analysis is going to help, but you never know for sure. So the answer is really going to depend on how well you know that company and what you think the stock can do. So in other words, it's going to depend on your level of conviction. If you really know the company inside and out, you use their products, the company's got something new that's flying off the shelves. It's got tremendous fundamentals in terms of sales and earnings and profitability. It's got great technicals. It's got a strong chart pattern. If you're in a favorable market environment, if it's got all these things going for it, that is the kind of stock you should probably hold on to for the big move. Because when a stock has everything going for it in that regard, it has the potential to be something special. And even more importantly, you can get behind it with conviction to help you ride out the highs and lows during the move. But let's face it, we don't always buy stocks we have a lot of conviction in. Many times I will buy a stock simply because I think I can make a quick buck. I might not know the company that well. I might not really understand what they do. I might not even like the company. But I'll buy it anyway because based on my chart reading skills, I think I can make a pretty quick profit. There's nothing wrong with doing that. Now, ultimately, I don't think that's how you're going to make the really big money in the stock market. But it's not realistic to think that every stock you buy is going to go up 100 or 200%. So it's okay to put on kind of a fast trade if you want, or buy something you really don't have a tremendous amount of conviction in. As long as you realize that if you're right, if you buy the stock and it goes up, you have to sell it and lock in your profit on the way up. Don't wait for technical sell signals. Don't wait for a warning sign. just lock in your profit when you've got whatever, 15, 20, 25%, lock it in. And the reason why we do that is because if you don't have conviction in what you own, you're never going to be able to hold it during the pullbacks. Trust me, if you don't have conviction in the stock, you will be shaken out when the stock comes back down. So it's really important to kind of know what you have. If you can lock in a 20 or 25% gain 3 or 4 times in a row, you've basically doubled your money. How often do you buy a stock that you make 100% in? Probably doesn't happen that often because it's not that easy to make that kind of money in a stock. Now, regardless of your objective, whether it's for a shorter term trade or to try to hold through a major advance, you have to be flexible. You always have to be flexible, and the chart must always confirm that your expectations can be reached. So let's assume that we do have high conviction in the stock. It's got all those factors I just spoke about in terms of the story and the new product and the earnings and the technicals. It's got everything. And you believe you've got a model book stock in your hand, a stock that has the potential to move up 1, 2, 3, 400%. If that's the case, you are not going to sell that stock until you see the warning signs that we're going to cover. When it comes to selling, we always base our selling on the technical sell signals, because most stocks will peak and begin trending lower well before the fundamentals break down. Remember, the stock market is a discounting mechanism. It's always looking ahead 6, 9, 12 months into the future. So if you're waiting for the bad news to hit before you sell the stock, chances are you're going to be selling way too late. So the chart is typically your earliest and best indicator that a stock is forming a top. So don't rely on the fundamentals. Let me go over an example. Now, this particular chart is not in your workbook, so I just want you to pay attention up here. This is Alliance Semiconductor in 1994. And it broke out of this cup base, and it had tremendous fundamentals when it broke out. If you can't read it here, let me just read it to you. It had earnings growth in the 40 to 60% range, and sales growth in the 70 to almost 90% range over the past 3 quarters. So it had tremendous earnings and sales growth. And Alliance Semiconductor turned out to be one of the biggest winners of that time frame, moving up nearly 600% in 11 months. Now, clearly, the stock is topped. But let's look at the fundamentals at this point on the chart. We went from those strong double-digit earnings and sales growth to now triple-digit earnings and sales growth. Let me just read you the earnings. It went from 140% to 178% to 300%, and then back down to 269%. Sales growth went from 123% to over 200% over 4 quarters. That is the best situation you can have in terms of fundamentals. Triple-digit accelerating earnings and sales, and yet if you held onto the stock because the fundamentals were so great and actually improving, you would have ridden the stock down 80% in 4 months. So don't wait for the fundamentals to confirm what the technicals are telling you. Now, I've broken down the sell signals into 2 categories. Offensive selling, which is selling on the way up into strength, and defensive selling, which is selling on the way down into weakness. Most often, you're going to see a combination of sell signals when a stock is putting in a top. You'll see some offensive, perhaps. You'll see some defensive. And one sign alone is not going to be enough to completely push you out of the stock. But as you see the evidence mount, you want to be scaling out of the position. So, you see one signal, you sell a little bit. You see another one, you sell a little bit more until you're convinced that a top has been put in. So you want to use a scaling approach. These are the different sell signals we're going to talk about. And Bill has said that it's always better to have 75% of your sell rules on the way up as opposed to just selling on the way down. Now, before we go into each of these, let me talk about a few drawbacks to selling into strength. And the most obvious one is that sometimes the sell signal will go off and you'll sell and the stock will keep moving up. So sometimes you're going to get out of the stock early. And sometimes you're going to get out really early. And psychologically, that's a really tough thing to handle. It's a horrible feeling when you sell your stock and it keeps moving up higher and higher without you. You will typically feel tremendous pressure to get back in, and you'll end up chasing the stock back and buying it extended in price. And that opens up a whole new can of worms that you increase your risk tremendously when you buy out a position. So let me give you a few things to think about. First, as I started this presentation, you're not going to sell it at the top. Don't expect to sell at the top. It's almost never going to happen that way. Remember, this is a game of probabilities. And the technical sell signals, offensive sell signals, will usually get you out somewhere near a top. But it doesn't always work like that. So if you sell stock based on the signals we're going to discuss, and it keeps moving up, don't get frustrated. Don't get mad at yourself. Okay, never get mad at yourself for following a rule, a sound rule. Just put it aside, keep it on your watch list, move on to your next winner. Secondly, as I mentioned, you don't have to sell your entire position at once. Use a scaling approach. When I buy stocks, I'm always scaling in. I never buy all at once, and I never sell all at once. Okay, so I mentioned it. As you see more and more signals, you act on each one of them. And lastly, if you are disciplined and patient and a little bit lucky, most stocks that will continue to move up after you've sold them, if they're really a strong leader and they have a lot further to go, they'll give you another chance to get back in. It might not be for 3, 4, 5 weeks, but they will typically give you another proper entry point or low-risk entry point to get back in. So always be patient and just wait. Okay, now let's get into the first one. This is on page 287. And the first question, yes?
On buying, you have the 50-30 point rule. Is there any similar?
That's a good question. So the question was on the buying, you've got the scaling approach as far as getting in little by little. Normally, no, I don't have like a formula for selling. Typically, if I see a sell signal, depending on how severe it is, I might sell 15 or 20% of my position and wait and see what happens. If it's really a very severe signal that really looks bad, I might sell half my position. So it kind of depends on what the stock looks like, but if you were to sell 20 or 25% at each sell signal, you would probably be out of the stock somewhere in the range of the peak. Okay, so let's talk about climax tops. A climax top occurs after a stock has already been running up for an extended period of time and has already made a big move. And then the character of the stock changes. It begins to move up very rapidly, accelerating in price, moving up 25 to 50% or more in a very short period of time, of typically 1 to 3 weeks. So think of it as a stock has been making steady progress over many months, and then it begins to move up in an explosive manner. Okay, on the chart, on a weekly chart, it'll look like it's moving up parabolically. Based on our model book studies, we found that this kind of action typically doesn't occur before the end of the 18th week out of an initial base or first stage base. So if you see this kind of action occur earlier in the move, there's a good chance that the stock is going to continue to move up. So you typically want to keep the stock for at least 18 weeks if you see this kind of action. You don't necessarily use it as a sell signal if it occurs early in the move. If you're lucky enough to be in a stock going through a climax, you're going to make a lot of money really quick. Many of our strongest model book stocks peaked in this manner. Let's go over the classic signals. They'll typically begin with a breakaway gap coming off a short consolidation. So the stock is going to typically gap up off a short consolidation. It might be a week or 2 weeks to begin the move. And then it's going to run up 25 to 50% or more in 1 to 3 weeks. Sometimes that climax portion of the move is extended to 4 or 5 weeks. I've seen it. But most often, 1 to 3 weeks is the typical range. You'll normally see your largest daily point gain of the entire move. From the very beginning breakout all the way to this point in the move, you'll see your largest daily point gain of the entire move during this phase. you will often see an exhaustion gap right near the end of the move, near the end of the climax. So an exhaustion gap occurs after the stock is very extended in price. That's different from a breakaway gap that occurs off of a base or off a consolidation. The stock will be very active. You'll see it up 7 or 8 days in a row, or maybe 8 or 9 days out of 10. You're going to see it up almost every day. You'll normally see your largest weekly price spread of the entire move. So from the weekly low to the weekly high, you'll see your largest spread on the chart going all the way back to the initial breakout of the base. You'll see often an excessive number of stock splits. So you may see during the entire move 2 2-for-1 splits, or even more than that. It's not just the number of splits, but also the size of the splits. If you see a 3 or 4-for-1 split, or even a 5-for-1 split, that is a very ominous sign if it occurs in conjunction with this kind of price action, the climax price action. So be aware of that. There have been a number of very high-profile leaders that topped right when it had one of these excessive splits. Qualcomm is a great example. It split 4-for-1 right at the peak. I'm going to talk about that one in particular in a few minutes. Taser, which was a hot stock back in around 2004 time period, split 3-for-1 right at the peak of a climax, and it was so powerful it kind of held tight and then went into another climax and split 2-for-1 right at the peak. Hanson Natural, which makes the Monster drinks, was a very, very hot stock, had an enormous run. It split 4-for-1 right at the peak. It went much lower after that. You will see the stock excessively above the 200-day moving average line at the peak of the climax. And you may see some forms of distribution. A break, first you'll see a break above the upper channel line sometimes. I'm going to talk about upper channel lines separately. And you may see some forms of distribution in terms of railroad tracks or an island top. I'm going to talk about those separately as well. So let's go over an example. This is on page 292. And this is China Life. China Life had a huge move after breaking out of this cup with handle base. It moved up nearly 400% in just over a year. And you can see the very steady advance that it had all the way up. And now focus on the last 3 weeks. You see how explosive it got, how it became parabolic? You can clearly see on here that it started to move up at an excessive rate here, and that's your climax top. And during that climax top, you had your widest weekly price spread on that first week. So let's look at the daily chart. And you can see it very clearly here how explosive it was. It went up 53% in 12 days. Now, China Life had almost all of the classic climax signals we just covered. It began with a series of breakaway gaps off of this very short 2 or 3 week consolidation here. So it started off with the breakaway gap. It ended with an exhaustion gap. So see how the exhaustion gap occurs after the stock is very extended, and then it again gaps up. So that's your exhaustion gap. It occurred right on the peak day. You also had your largest daily point gain right on that peak day. Okay. At the peak, you were about 100% above the 200-day moving average line. Our studies have shown that the average distance a great leader gets over the 200 days is about 100%. So that's about average. Sometimes there are stocks that are so powerful they'll get much further above, but this was right in there at 100%. It got right where most stocks, model stocks, peak. You can see how active it was. The volume was very high. Your rule when you realize that your stock is in a climax run is to sell all your shares as there are a flurry of people trying to buy them from you. You sell everything. You don't have to sell it all on one day. Don't pretend you're going to sell it right at the peak. It's not going to happen like that. But as you realize that you're in a climax situation, you want to begin scaling out day by day, selling into the strength. Because once the stock peaks after a climax, oftentimes it falls like a rock. and there's no one left to buy your shares. Now, most often, once a stock has a climax top, it's finished. In fact, in your book, at the back of that section, I show the aftermath of what happened to these stocks, to the climax top examples in the workbook 3, 4, 5 years out. And what you're going to find is that most of the time the stocks never came back. And if they finally did come back, it took years. Now, in a few instances, on the minority of the time, a stock will be so powerful that it actually will form a base or a consolidation and continue to move up. So you never want to completely write off a stock that's had a climax top. Just keep it on your watch list and see how it behaves. Qualcomm, on page 312, is a great example of a stock that was so powerful that after the first climax, it held tight and then moved up again. Qualcomm was one of the biggest leaders in the technology bubble, went up 2,500% in just 1 year. It's one of the biggest winners of that time frame. And you can see how powerful it was, and it formed this ascending base midway through the run, and then went right into a climax after that. And then it held tight. It did not fall apart. It held tight, and then went into another climax run. You have your widest weekly price spread right at the peak of that second run. You also have your excessive 4-for-1 split. You have a 2-for-1 split earlier in the move, and then an excessive 4-for-1 split that occurred right on the top day. On the peak day, you got your 4-for-1 split, and Qualcomm has never been higher. It's been over 10 years. It's never gone higher than this. Here it is on the daily chart on page 313. So here is your little ascending base here. It looks very compressed because this is an arithmetic chart and the stock had such an enormous move. But that was your ascending base, and you broke out, and look, you started with a breakaway gap. So in classic fashion, you started with a breakaway. The stock moved up 77% in 8 days. It was up 7 out of 8 days. On that final day, you get your exhaustion gap. So again, classic sell signals. And the correct thing to do would be to sell into this climax run and then wait and see what happens. At the peak of that climax, you were over 200% above the 200-day. Only 5% of the model stocks that we've studied ever got that high over the 200 days. So this is very rare. Now, Qualcomm held fairly tight after that climax run. That little green line on the chart is your 10-day moving average. It pretty much held the 10-day for about 5 weeks, and then it broke out again. Now, if you had nerves of steel and if you had a lot of guts, you could have bought the stock back right over there. That was a perfect buy point because you know exactly where your risk is. So when I talk about low-risk entry points, a low-risk entry point means that you know when you're wrong. If you bought the stock here, and next thing you know, you're down here. If you undercut, let's say, this little point here, you know that's not normal. If you wanted, you could have bought the stock back right here, and the stock went on and doubled in 3 weeks. On the second one over here, you're right. The volume was not tremendous up here, but it still works. Sometimes you don't always get the volume, and you have to go off the price action. But that's an excellent point. You did have lower volume on the breakout here. You also had pretty low volume here following the climax, which is constructive. Normally, you would think the stock would fall apart on huge volume, but instead, there just weren't a lot of sellers in here. So on that second climax run, again, 100% in 3 weeks. You have your largest daily point gain about 4 days before the peak. You have an exhaustion gap. I believe that exhaustion gap occurred on an upgrade. Actually, it wasn't an upgrade. I think an analyst initiated coverage on that day. Started coverage. So the stock's already gone up 2,000%, and they decided to put it on the buy list. You can't trust the analysts. They're smart. They're very intelligent, but that doesn't mean they know what they're doing with regard to the stock market. So again, this was Qualcomm. It had 2 climax tops. And once it corrected after that, it never came back. Okay, let's move on to the next offensive sell signal, which is a break above the upper channel line. And this is on page 333. Sometimes your stock will advance at a very steady rate of growth so that you can draw a trend line or a channel line above the peaks of the price bars. Now, to draw a proper channel line, it should be done on a weekly chart or a log chart, because weekly charts are log charts and you can clearly see if the stock begins to accelerate at a faster rate of growth than it had in the past. Now, I have, for the first time, actually drawn the trend lines on both the weekly and the daily chart, because the daily chart will give you a good approximation. If a stock clearly breaks over the trend line, you're going to see it on a daily chart too. And I know some people prefer daily charts, so I put it on there. But if it's a close call, you want to always rely on the weekly chart. Okay, the weekly chart is what you should rely on. To draw a proper channel line, you want to connect a minimum of 3 points along the peaks of the price bars over a period of at least 18 weeks. All these numbers come from our model book studies. You know, what fit the best parameters. We normally found a long period of time works better than a shorter period of time. The more peaks that you can connect, the more dots you can connect, and the longer the time period, the more resistance that line is going to offer, so that if you keep butting up against that channel line and then suddenly you break above it, that's an indication that the stock has gotten ahead of itself. It's beginning to move above its normal rate of growth, and that's the time to take a little money off the table. Now, this is going to offer you a bit of a dilemma, because I also mentioned previously that climax tops will often extend above the upper channel line. So what do you do if you find a stock moving up above the channel line? Do you sell it immediately, or do you wait and see if you're in a climax top situation? You should wait and see if you're in a climax top situation. Pay really good attention, because you don't want to sell your stock if it's about to begin a climax top. But if you break above that channel line and then quickly reverse, you know you're probably not in a climax top situation. You can begin selling. Sell a little bit, maybe, is the answer. Scale out a little bit. But don't sell everything if you might be beginning a climax. So let's go through some examples. Well, first, on page 333, we have a line chart where I connected 4 points along the peaks. And when you go up above that line, that's when you're extended above your normal rate of growth, and you sell some of your shares. So on page 358, we have Thomas and Betts. And this stock formed a series of bases along the way up. And finally, when it broke out of the cup with handle on that last base, it moved up in a very steady rate. And we were able to connect 1, 2, 3, 4, 5, about 5 points along the peaks. And when you finally extend above that channel line, that's when the stock hit a peak and then reversed. Here's what it looked like on a daily chart. So again, I drew the channel line to kind of give you that approximation, and it was clear in this one that the channel line would have told you on both the daily and the weekly that you were extended above the normal rate of growth. But you always want to, again, rely on the weekly chart. And when you extend up above this rate, you were extended and you quickly came back off. So again, you want to keep an eye on that and scale out when you are above that normal rate of growth. Notice that you're going to see more than one sell signal. So we've got your offensive sell signal breaking above the upper channel line. We also have a weak rebound rally, which we're going to talk about in a little bit. You have your largest one-day point loss, which is another sell signal we're going to talk about. You finally have your break below a 50-day moving average, another sell signal. So you're going to have more than one opportunity to get out of a stock and to convince you it's putting in a top. You're not going to sell it right at 61. Okay, but if you can get out anywhere in this range, you're doing well. On page 360, we have Tractor Supply Company. And again, we connect 1, 2, 3, 4 points along the peaks. And then you just go up above it over here in this climax top, and then you fall apart. So this is one of those examples where you had both the climax top and the upper channel line. If you get both those indications, it's going to be pretty simple for you to recognize the stock is putting in a top. Here it is on the daily chart. And here's your break above the line. And again, it's coincident with the climax top. You're up 7 days in a row, and then you peak. It started off with a breakaway gap, so it had a number of those indicators that we've talked about. Okay, the next one is on page 363. And this is your sharp pullback and fast recovery to new highs. Now, we've often noticed in our model book studies that after a long advance, a stock will have a very severe sell-off to the 50-day moving average and then go right back into new high ground before rolling over. Doesn't always work out. It's not perfect, but if you've tested the 50-day moving average on one or more occasions successfully, and then after a long advance you get this very severe action down and then a sprint right back up, it's a good idea to take some money off the table as you're getting into new highs. Again, it doesn't always work, but I've seen it occur often enough so that it's, I think, a smart way to manage your money. Now, the pullback to the 50-day is going to be very severe, either a gap down or a series of large one-day drops down to the 50-day. It's going to look terrible. Now, the move back up to new highs, I've seen that occur on low volume, and I've seen that occur on heavy volume. So don't be convinced that just because the stock moves back up on heavy volume, that that's necessarily a really great sign and you're just going to stick with it. It's still a good idea to take something off the table as you go into new highs. If it does occur on low volume, by the way, then that in and of itself is a sell signal. That's called a light rebound rally, and we're going to cover that after this one. Now, this kind of price action, the pullback to the 50-day and the sprint into new highs, is going to typically occur in some combination of 1 to 3 weeks down and 1 to 3 weeks back up into new high ground. So you might see 1 week down, 2 weeks up. Maybe it's 3 weeks down, 1 week up. Any combination of 1 to 3 down and 1 to 3 up is normally what you see. So let's go over some examples. On page 365, we have AIXG. This is a German company that makes equipment to make semiconductors, and they are in a very hot area of the market. This is actually a new ad for your workbooks that I put in, and some of you may have been trading this stock. They make equipment that supports the LED manufacturing, and Cree is the top leader in that space. And you can see the stock had a tremendous move. It continually found support at the 50-day moving average. And then look at this particular pullback here. It comes all the way down to the 50-day, and look how severe it was. You've got a gap down and then another bad gap down to the 50-day, closing right at the low. And then you go right back into new high ground. That's where you want to sell some shares. Let's take something off the table. That's what I'm talking about. After you've had support at your 50-day on one or more occasions, you get that severe pullback, it bounced right back into new highs, and then it went into a basing formation. So you don't want to necessarily sit through this. It'd be better to sell it up here. On page 377, we have JLG Industries. Stock's in a very solid uptrend here. You can see it continually makes higher highs and higher lows along the way. That, by the way, is the definition of an uptrend. Higher highs and higher lows along the way. Right before it peaks, you get this very severe pullback to the 50-day. You have your largest one-day point loss of the entire move in that pullback. And you move right back up over the next 3 weeks into new highs, and then you roll over badly. The question was, is that an indication that institutions are dumping shares? Usually if you see heavy volume come in on the downside, that is an indication institutions are dumping. So that large one-day point loss is one indication that there's probably some institutional selling pressure behind it. Also, if you see a stock churn near the top, if you see heavy volume without the stock really moving up anymore, that's usually institutions kind of laying out their shares. As there's still buyers, they're picking up shares. And I'm going to cover that churning or stalling separately a little bit later. All right, let's move on to the next offensive sell signal on page 385. And this is when a stock has a rebound rally on light volume. Now, healthy price and volume action occurs when a stock is moving up on somewhat heavier volume and then pulling back on somewhat lighter volume and then reestablishing some heavier volume, moving up again. So moving up on heavy volume, moving down on light volume. That kind of action is indicative of a stock under accumulation. If you get the reverse, if you get the volume and price action divergence so that you're moving up on light volume and moving down on heavy volume and then moving back up on light again, then that is an indication that your stock is coming under distribution, and that's a sell signal. So it's really important that the price action be confirmed by the volume action. So let's take a look. Now, Alliance Semiconductor was that stock I showed you at the very beginning that had the tremendous fundamentals at the peak. Remember, I had those accelerating triple-digit earnings and sales, and then it fell 80%. Well, you didn't have to rely on the fundamentals. You could have gotten out just based on the technicals alone. This is on 387. So toward the end of the move, it broke out of this somewhat sloppy base over here. It ran up very strongly. And you have this sharp pullback here, and then look at the volume as the stock is rebounding back up. Look how light that volume is relative to previous advances earlier in the move and relative to the 50-day moving average volume line. So that is a classic light rebound rally, and you want to take advantage of that temporary price strength and sell into that. After that, the stock came down sharply, undercut your 50-day moving average decisively, and then rebounded again on volume that dried up, and then it was over from there. It really got bad. So that's one offensive way you could have gotten out of that stock somewhere near the highs before it really got ugly. HITK, High-Tech Pharma. This is a new stock that I just added in the workbook. And this one was a stock I actually traded. I was actually in the stock, and I failed to see these warning signs, and I got caught on this horrible day here. The stock broke out of this cup with handle, had a tremendous move up, pull back to your 50-day, and it had a lot of indicators in hindsight that I should have paid attention to. You had stalling right on that top day. You see how you moved up strongly but closed right near the low of the day. Then you have your largest one-day point drop on heavy volume. And you come down here and you get support at your 50-day, and then you get this weak rebound rally. You can see the volume just dries up each day it's moving up. And then you come back and test the 50-day again, and then you get another opportunity to sell. Volume dries up. Look how light it is as the stock is moving back up, and then it rolled over and volume really came in. So really important to recognize those light volume rebound rallies and sell into them. Okay, so the last offensive sell signal is when a stock goes into new high ground on low volume. If a stock is moving into new high ground on low volume, it's suggestion or indication that institutions are not behind the buying. Institutions dominate the market. Mutual funds, hedge funds, pension funds, they dominate the market, and they're the driving force behind these great stock leaders that we find. So if your stock is moving up on light volume into new high ground, there's probably no institutional support behind it, and so that stock movement, you can't trust it, basically. So again, it's important that the price action be confirmed by the volume action. So here's an example. This is Holly Corp. And here, again, the stock is in a nice steady uptrend here. Notice higher highs and higher lows along the way up. And then right over here, as you're moving into new high ground, look at the volume. If your volume is drying up as you're moving into new highs, right down over here, you can see that's well below your 50-day and also much lower than what you've experienced earlier in the move. So you can sell into that kind of price action. Oracle is the next one we're going to cover on page 409. And this was occurring during the great technology bubble days. And we see right as the stock is moving into new high ground, we've got below average volume all of those days. So you can't expect your stock, by the way, to move up every day on heavy, heavy volume. That's not realistic. But normally you want to see your stock break out or move from a fresh consolidation into new highs on a pickup in volume. That's much healthier. Here, there's no volume here. And then when the stock comes off, you've got really heavy volume. So that's the divergent price and volume action I talked about. Moving up on light volume, moving down on heavy, and then you get a weak rebound rally. So you did get an opportunity to sell into strength before the stock peaked. And that's another example of a stock that's never come back. You know, it's been 10 years, the stock is still way below these levels. Those are all of the offensive sell signals.